This chart compares the true scale of the capital markets. Equity markets grab the headlines with their daily volatility. But if you look at the total capital circulating globally, the fixed income market dwarfs the equity sector entirely. This asset class is the primary mechanism that governments and large corporations use to raise the capital required to run the global economy. At its core, a bond is a legally binding contract. An issuer borrows money today and commits to paying a fixed percentage of interest, called a coupon, at regular intervals, before returning the original principal on a set maturity date. This presents a strict mechanical problem. Since the future cash flows are locked by contract, how do portfolio managers assign an accurate, objective daily price to these assets while the broader macroeconomic interest rates constantly fluctuate? To navigate this, a portfolio manager relies on three technical pillars: assessing the issuer's credit quality, running a discounted cash flow valuation, and measuring price volatility with duration. Managing a fixed income portfolio relies on executing the precise mathematical relationship between external market yield and internal asset price. Before running any math, we must identify the debt issuer. In the Indian market, this broadly splits into government securities, or GSECs, and corporate bonds. Every bond carries specific intrinsic features: the issue price, the face value, the coupon rate, and the tenor, which is the exact time until maturity. These features are locked into the indenture, the master legal agreement between the borrowing issuer and the lending investors. The indenture outlines specific covenants to protect the lender. Positive covenants require the issuer to perform specific actions, like maintaining financial ratios or providing audited reports. Negative covenants legally restrict the issuer from taking actions that could jeopardize the bondholder, like issuing excessive debt or liquidating key collateral. Instead of analyzing these covenants individually, investors rely on credit rating agencies to synthesize the legal protections and financial health into a single metric representing the probability of default. The long-term debt scale grades instruments maturing over 1 year from AAA, indicating highest safety, down to D for default. For maturities under 1 year, a short-term scale is used, graded from A1 down to D. Establishing this baseline credit safety is a strict prerequisite. We must be confident the issuer will make their payments before we can project and value those cash flows. Here is our theoretical asset: a bond with a 1,000 rupee face value, a 12% coupon, and a 5-year tenor. Over these 5 years, it generates 10 identical semi-annual payments before the principal is returned. To assign a present-day price to this asset, we use a discounted cash flow framework. This relies on the time value of money. A rupee received 5 years from now is worth less than a rupee in your hand today. We account for this difference using a discount rate, which is the specific minimum rate of return an investor currently requires to justify putting their capital at risk. The standard present value formula applies this logic to every single future cash flow on our timeline. It reduces the value of each upcoming payment, summing them together to find the bond's intrinsic value. Calculating this manually across 30 or 40 cash flows is tedious. Portfolio managers execute this calculation instantly using software functions, like the price formula in Excel. This underlying math reveals a strict mechanical rule driving the fixed income market: the yield-price inverse relationship. Because promised cash flows cannot increase, a rising market rate makes the discount rate larger, shrinking the present value. If the market rate jumps to 15%, our 12% coupon is uncompetitive, selling at a discount. Conversely, if the market rate falls to 9%, our bond becomes highly attractive. Buyers will pay extra, pushing the intrinsic value above the face value to sell at a premium. When an investor buys the bond at its current market price and holds it to maturity, the specific discount rate equating that purchase price to the sum of all future cash flows is the yield to maturity. Intrinsic value is entirely dynamic. The bond's price must continuously move in the opposite direction of the market yield, precisely because its schedule of future cash flows is locked in place. That strict schedule of cash flows assumes the bond survives to its stated maturity date. However, certain bonds include embedded options that legally disrupt the timeline. A callable bond gives the issuing entity the right to pay back the principal and retire the debt before the maturity date. Issuers trigger this when market interest rates drop, allowing them to refinance their debt at a cheaper rate. This forces a specific hazard onto the investor, known as reinvestment risk. Their capital is returned early, obligating them to reinvest those funds into a new market environment that now offers lower yields. A puttable bond places the option in the hands of the investor. It grants the bondholder the right to sell the bond back to the issuer at a predetermined price on specific dates. If market interest rates rise significantly, which would normally crush the bond's market price, the investor can exercise the put option, guaranteeing an exit price and preserving the capital. Embedded options directly alter the baseline DCF valuation. They transfer specific interest rate risks between the two parties, capping the potential upside for one while limiting the downside for the other. A bond's market price is continuously driven by 4 variables: its par value, its coupon rate, its time to maturity, and the prevailing market interest rate. Of those 4, the prevailing market rate is the primary external variable. Portfolio managers must actively measure and hedge against this specific exposure, known as interest rate risk. 2 mechanical rules dictate how severely a bond reacts to interest rate shifts. First, bonds with longer times to maturity experience higher price fluctuations. Second, bonds with lower coupon rates are more volatile than those with higher payouts. This visualization represents how analysts quantify volatility using Macaulay duration, evaluating the exact pull of a bond's cash flows. It determines the precise balancing point, measured strictly in years, representing the weighted average time to recover the initial investment. The only structural exception is a zero-coupon bond. With no intermediate interest payments to balance, its Macaulay duration exactly equals its final maturity date. Knowing recovery time is useful, but predicting price movement requires modified duration, the exact multiplier for interest rate risk. A bond's price change equals negative modified duration times the yield change. A 1% yield increase on a 5-duration bond causes a 5% price drop. For a portfolio manager, fixed income pricing is never an abstraction. It requires synthesizing credit safety, rigidly charting future cash flows, and quantifying the exact mathematical boundaries of duration risk.